Choosing investments is an important step on your path to a secure financial future. It may seem complicated, but once you understand the basics, you can build your ideal portfolio. The first step is understanding your risk tolerance. Risk plays a big role in investing because markets can be unpredictable, meaning the value of investments can rise or fall. When you have a lot of time before you retire, your money has more time to recover from losses. That allows you to take more risk than you could if you had to retire in just a few years. On the other hand, staying safe with your investments has its own risk because safer investments typically don't earn as much as riskier ones. While your nest egg might be more secure, it won't grow as much or as quickly, resulting in less money when you're ready to retire. The next step in choosing your investments is to diversify. You can manage the trade-off between risk and return by including different types of investments, diversifying in your portfolio. Here's how it works. A mix of different investment types, also known as asset allocation, provides cushion and reduces risk. The main types of assets found in retirement plans are stocks and bonds. Stocks represent pieces of ownership in a company with unlimited growth potential and the risk that the company could lose value. Bonds are like loans with guaranteed interest and principal payments. They don't have the same growth potential as stocks, but carry less risk. Even though stocks are considered riskier investments, historically, they've outperformed every other type of investment over the long term. Bottom line is that while you may lose money in any given year, when you're young, you have time for your portfolio to recover. The next step in choosing your investments is to review your allocation mix regularly. Circumstances change, and when they do, consider rebalancing holdings in your portfolio. The three main reasons to make changes in your investments are: 1. Your risk tolerance has changed. Your risk tolerance changes as you get closer to retirement. The most common way to address that is to increase the percentage of lower risk investments in your portfolio. 2. Your life situation has changed. When your personal situation changes, for example, getting married or having children, review your retirement savings. And 3. Market performance has changed the value of your investments. Revisit your portfolio periodically, at least once a year, to see if the diversification still matches your plan. The last step in building your portfolio is keeping an eye on fund fees. Funds come in two main types, managed and passive, and they charge different fees. Managed funds count on financial professionals to actively choose every stock or bond and when to buy or sell for highest profits. This hands-on approach means higher fees and trading costs. Passive funds, also known as index funds, include preset list of stocks or bonds, usually based on an index such as the S&P 500. This hands-off approach means lower fees and trading costs. Bottom line, choosing passive funds can minimize fees and often outperform managed funds. For more information and more resources, including the Starting to Save for Retirement booklet, visit wi65.org.